Callie, I'm going to begin with you this morning. What do you make of some of what we're seeing when it comes to tech? Shares of Apple actually up about 5.5%. We're seeing tech broadly trading higher. Obviously, it's on that tariff pause.
Yeah, well, I think this was expected heading into Monday. We saw obviously those headlines around the tariff exemptions that were later walked back by President Trump. I'm not sure tech investors quite know what the situation is, but tech has been hit really hard in this sell off. So this could be a relief rally of sorts, a relief rally that I wouldn't necessarily believe in.
Wouldn't necessarily believe in it. Nancy, coming over to you. Are you surprised to see investors have so much confidence in tech? I'm looking at NVIDIA shares up just about 2.5% as well. When you're getting so much mixed messaging from this administration, the president on Truth Social, the Commerce Secretary on TV just saying, not so fast. It's not really an exemption, that these tariffs are actually going to be coming down the pike sooner than later.
I do think there's a lot of euphoria in the equity market. It's pretty mind-blowing to think that the market actually had a huge up week in equities, especially given what happened to 10-year yields last week. And real yields rose. So the bond market was telling a completely different story than what was going on with equities. And I think it'll be wait to see which market is correct, but you have a tale of different stories based on where you're looking.
Yeah, to your point about some euphoria in the market, I think everybody's kind of looking for a bounce or the markets to bounce off the bottom. I want to read something to both of you from Evercore that came out over the weekend. I'm reading in part of what they had to say. They said about 80% of companies are trading at a discount to their 5-year average PE. Tends to be followed by a rally. A Trump pivot, DC unwilling to precipitate a recession, supports this week's bottom and the S&P 500 to 5,600. Callie, coming back to you. Do you agree that we're just kind of primed for a bounce right now? The fact that stocks are trading at a discount and that there's an opportunity for a Trump pivot and, just as Nancy may have called it, some euphoria, people hoping for better days.
Well, clearly we are primed for a bounce, Frank. That's what we saw last week in the markets. There's a reason why it was the biggest week we've seen in years, yet tensions are still so high. I mean, when you're ready to get punched in the stomach, the punch doesn't hurt so bad, right? But I think we have to be careful when we're talking about timeframes here. Yes, in a matter of days, we could see a relief rally, and we are seeing a relief rally here, especially in beaten down shares. But if you look over the following weeks and months, we still have to process the fact that we could be in a recession right now, and the data just hasn't shown us yet. So we're telling investors to be careful, of course, focus on your long-term plan and have a process here, but don't believe these bounces that you see. The biggest up and down days happen in bear markets.
All right, so you're a little skeptical of the bounces. Nancy, coming over to you. The important part about PE sometimes is the second part, the E, and we're in fact in the earnings season for that. E is for earnings. Any thoughts about the fact that earnings may be a bit depressed and that these PE multiples that people are saying a discount, they may be misleading in any way?
Yeah, I think you also have to look at the debt side of the equation. Since we had the Fed hike rates so aggressively and have held those rates up for a very long time, you have to look at corporate balance sheets and see how much the debt servicing is going to be. A lot of people are focused on that with the U.S., with the Treasury and the refinancing on the fiscal side, but you also have to look at corporate balance sheets. And I think that's super important if you're, everyone who's watching, when you have stocks and you have corporate bonds, you really have the same corporate beta, right? It's all corporates. It's just a different part of the capital structure. So I think a lot of people can use the sell-off in the rates market and the Treasury market. Even tip real yields, they rose tremendously, meaning prices got cheaper for inflation-protected bonds. It's kind of mind-blowing when you look at your screens and you see the 10-year break even at 223, and the Fed's expectations is right around that 2%. So owning long-term inflation expectations, I think, is a pretty no-brainer in this environment.
Nancy, to that point, is this the environment right now where you really want to hold gold? We often talk about, stocks, bonds, and alternatives. But right now, is this the time to hold a commodity like gold or maybe copper, other things that are going to definitely be in demand and could potentially be an inflation hedge?
I think, a lot of people look at gold as an inflation trade. I think the thing I like to remind investors is even the TIPS market, so those are Treasury inflation protected securities, they didn't start until the late 90s. That was when the U.S. Treasury first issued them. So people looking back at the 70s and 80s, gold might be a fine holding, but the price has gone up a lot. It's a lot cheaper on a valuation basis to just own the rates market, own inflation expectations in rates. It's just a lot of people don't look at it because it didn't exist back then.
Callie, I want to give you the last word. Right now, do you want to own gold? Is right now the time to maybe increase your exposure to gold?
I agree with Nancy. I think tips are interesting here, especially now that the price has come down a bit. We hold tips in our portfolios as a tactical position for unexpected inflation. And I think it's easy to say that right now, one of the worries is unexpected inflation around these constant changes in tariff policy. Real assets like gold, still interesting, but we prefer to lean on tips.